I'm a very strong believer that you should always pay attention to what the smartest guys in the room on any given topic are doing for themselves. Through the third quarter of 2024, that there has been more central bank gold buying in this quarter than the past 3 quarters. And we've been making new record highs in terms of gold buying. And I'm pretty sure I don't know all the gold buying that the central banks are actually doing, because China, even though they stopped for a while, China's buying it again, except they also mine gold. And so we don't know what those numbers are. When you see the smartest guys on what they're doing to destroy this stuff in the room buying gold hand over fist, I think that kind of says it all.
Central banks continue to underscore the critical role of gold as a stable asset, with 2024 witnessing record-breaking purchases, particularly in the third quarter. Lynette Zang, a prominent analyst, highlights that China's gold acquisitions may be underreported due to its domestic mining and stockpiling practices. This aligns with broader global trends reaffirming gold's importance amid economic uncertainties. A World Gold Council survey reveals that many central banks plan to expand their gold reserves, marking the highest level recorded. Key drivers for this trend include high interest rates, inflationary pressures, and geopolitical instability. These factors suggest that central bank gold purchases will likely remain elevated through 2025. Notably, India is expected to reclaim its position as the top consumer of gold jewelry next year, coinciding with its forecast as the fastest-growing major economy. This surge in demand has prompted optimistic price forecasts, with Goldman Sachs predicting gold could reach $3,000 per ounce by the end of 2025. The BRICS nations have significantly shifted their central bank reserves over the past 2 decades. Once dominated by the US dollar, their reserves increasingly include gold, signaling a strategic realignment in response to global economic shifts. Investment demand for gold is also on the rise. After 9 consecutive quarters of net sales, ETF investors added 95 tons of gold to their holdings in the third quarter of 2024. This rebound underscores the renewed interest in gold as a hedge against economic instability, particularly as central banks and institutional players strengthen their positions. However, Zhang cautions against market manipulation that undermines the role of physical gold. She argues that paper contracts and derivatives, such as those issued by the Chicago Mercantile Exchange, create an illusion of gold supply without being backed by physical assets. These instruments divert investor funds from tangible gold into manipulated financial products, benefiting governments, central banks, and financial institutions at the expense of individual investors. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I want you guys to understand this really, really clearly, that this whole money market is a con game, and con games require confidence, and they also require new money coming in all the time. And when they use these derivatives, these paper contracts to create gold, it looks like out in the marketplace that there's all of this gold that there isn't. So the CME, the Chicago Mercantile Exchange, and they create a whole bunch of these derivative contracts. So there used to be a 500-ounce gold contract. Well, now there's a 100-ounce gold contract. It's much cheaper to buy that than to buy 100 ounces of gold, right? So in theory, you can convert that contract and take delivery of that underlying gold. But again, markets, con games always need new participants. So the CME brought out a macro contract that instead of it being 100 ounces is 10 ounces, but you cannot convert that into the physical underlying gold. There isn't even that thought that you might be able to do it. And that had this year so far for 2024 in both the gold and the silver macro contracts soared. I mean, more than ever. So that means that there was a whole lot of gold that was created through these contracts without even the concern that any of them were going to convert into the underlying physical. No concern about that at all. But if I remember correctly, and I don't have these numbers in front of it, I'm pretty sure that they created over 1 million ounces of silver through those macro contracts. And then I think it was something like, do you remember, Arthur, how many ounces of gold there was? It's a ton. It's a ton. Now they're trying to bring out a 1 ounce contract. And of course, you're not going to be able to convert that. But what they're doing is they are lowering the barrier to entry, making it less and less expensive. So people think they're buying gold. They're not buying gold. They're buying something that is pegged to the spot market contract. So they're using a contract against a contract. And in that case, it has not been formally legalized yet, but they're anticipating this to come out in January. What they're doing is they're misdirecting people away from the physical, like this, into the contract. How much more gold can they create? Well, they're doing it because there's surging demand. And they don't want the little guy owning gold, owning real gold in really any of these coin forms. They prefer it. And when I say they, I mean government, central bankers, and of course, Wall Street banks would prefer you to just own their contracts that they create that make it for their benefit. So a bear case for gold would be that they get to come out with this 1 ounce contract. And just like they've done with so many other things, including cryptocurrencies, they divert the money that would go into this that will actually protect people because it has the broadest base of functionality and buyer into just paper contracts.
U.S. inflation remained stable in November, rising 2.7% year over year, according to the Bureau of Labor Statistics' latest Consumer Price Index (CPI) data. This marks a pivotal moment as the Federal Reserve decides whether to lower interest rates for the third time this year next week. After maintaining rates at 5.25% to 5.5% for over a year, the Fed began easing policy in September. Chair Jerome Powell recently expressed optimism about progress toward the 2% inflation target, but acknowledged the potential impact of rate adjustments on the labor market. As a financial analyst, Lynette Zang warns that shifting toward a more straightforward monetary policy could sustain inflationary pressures, with the U.S. exporting these effects globally. She emphasizes recognizing the divide between physical and speculative markets as these policy shifts reshape the financial landscape. For investors, understanding this divergence is key to navigating an environment shaped by fluctuating inflation and monetary easing. As the Fed balances rate cuts with economic stability, the ripple effects on markets and investments will remain closely watched. Let's get back to the interview.
The reality is, though, is we are in a currency life cycle issue. So I think that the first part of that was, definitely President Trump wants to be the crypto capital of the world. He owns a crypto company. He's putting in entities in his cabinet that support his trading mentality. And so, yes, you would see the funds that would have gone into even just the digital markets. You've seen them go to other places, and we've seen Bitcoin go away above 100,000 an ounce because of all of this risk on. Also, mergers and acquisitions. There are the entities that would oversee that before are much more prone to allow certain mergers and acquisitions to go on. And there's an awful lot of private equity money floating around. This is either through all sorts of, CLOs, which are derivatives. So they just create a whole lot of leverage and a whole lot more money. And it's still an easy money policy. And so if the Federal Reserve does indeed lower the rates coming up or into the future, it doesn't matter. They never really tightened policy. They just said that they tightened policy, but their data, the financial stability report from 2024 is really talking about that disconnect between geopolitical moves and the high valuations and market complacency. So it's risk on, baby. And President Trump's son said just recently that the party's just getting started. So if this is a trading mentality in a trading market, the funds that would have gone to, well, look, There's a physical market and there's a paper market. So what we're really referring to is the paper market, because I'm not rushing to sell my gold because it's risk on, right? But then what I own is physical. I don't own the paper gold. I just own real gold. But that's really what's happening in here, is that this is such a trading market, and the support is in there for a lot more deregulation, a lot more mergers and acquisitions, meaning the biggers are going to get even biggers, and the opportunity for private equity that has been thriving since at least 2000, and I think it's 2013 is when that market really started to take off in a very big way because of all the, because of all the easy money policy. And that really hasn't gone away regardless of what they want you to believe. You look at the data, their data, not my data. Look at their data. They admit easy money policy, and we're easing into an easy money policy. That means a lot more inflation. And we're still going to export that all around the world. I think it'll be interesting to see how badly Powell wants to keep his job. I'll say that. I don't know. We're going to find out. But the bet is that they're going to ease into this easy money policy. I mean, that's what they did by dropping the rates 50 basis points. Bank of Canada just dropped their rates 50 basis points. The last time when they did that, they said it was to stick that soft landing. But actually what it is to generate more inflation. And so that's the battle, right? Inflation, deflation, they're on the same coin. They're just the opposite side. And there's only one way to fight that deflation, and that's with inflation. And only one way to fight that inflation, and that's with deflation. So I think that the higher for longer, I mean, we're going to find out. That's way above my personal pay grade. But they want more inflation. And that's why I said, I think that I know we've already entered the melt up phase by them really never really tightening that credit, and all that money that's still sloshing around out there is really supportive of a whole lot more inflation.
Gold continues solidifying its role as a cornerstone of economic resilience, serving as a hedge against inflation, geopolitical uncertainty, and shifting monetary policies. Amid global economic adjustments, the renewed focus on physical gold highlights its enduring value in a landscape often dominated by speculative financial instruments. As central banks, institutional investors, and individuals recalibrate their strategies, gold's significance remains unmatched in preserving wealth and stability in uncertain times. What strategies most effectively safeguard financial security in today's evolving global economy? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.